The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, Thursday the 6th of February. It's good to be back, and Jeremy is still away. He must be laughing from the beach at what's been going on this last week, but it gives me the opportunity to reintroduce another of the Progressive team. So today I'm delighted to be joined by Alastair Stewart. Alastair, good to have you back.
Good to be back myself. Bye.
Yeah, it's good to talk through the building construction space, and Alastair will be giving us the benefit of his views and wisdom on that in a couple of minutes. But before we get to that, there's quite a lot to talk through in terms of what's been going on, in particular across the pond. We've obviously had Donald Trump with his extreme gyrations around tariffs, the on-off battles with the US's closest neighbours, Canada and Mexico. And I'd say it's extraordinary how quickly Donald Trump moved to impose those after his inauguration and taking his role at the White House. And then he announced those tariffs, but with a bit of a delay in each case. He used that delay in both situations to have discussions with the country's leaders and was able to announce what he described as a very significant win in each case, and then remove the threat of tariffs. Whether or not those were real wins is open to debate. Some people would say that they were policies that both Mexico and Canada had previously talked about or were prepared to do, so they didn't really give much away. Others would say that Trump achieved a real victory in helping secure both borders and helping get Canadian assistance with stopping the flow of drugs and Mexico's assistance with stopping the flow of people. I would say it's pretty clear that the markets will have looked at that with some degree of astonishment and perhaps amusement. But what's also clear is that there is now an increased risk in the way that the US deals with even its closest neighbours or closest partners. Clearly, there's a battle yet to be fought with the European Union, potentially even the UK, and rational investors will have ratcheted up their views of the risk of these sorts of tariffs coming in potentially for significantly extended periods of time, and they will be reducing their propensity to invest capital or their willingness to open factories or do deals with not just the US's trading partners, but also with the US itself. So everything's been rocked a wee bit there. In the midst of all this, the US has imposed tariffs on China. There have been 10% tariffs put in place. China's immediately retaliated, and they've put their own tariffs on a number of goods coming into China from the US. And I think possibly even more importantly, China is now limiting the export of certain additional metals. They previously put some constraints in place relating to some rare earths just over a year ago. They've expanded that list in this last few days. So there's a proper tit-for-tat battle going on between the US and China. That hasn't had a huge level of exposure or discussion in the media, but that might be quite an interesting one to watch. And clearly, Donald Trump's not going to get quite the same reaction or the same opportunity in his discussions with China as he's been able to exploit in his conversations with Canada and Mexico. But closer to home, the UK's also had quite a lot going on. We had a rate cut from the Bank of England, 4.75 down to 4.5%. Two of those voting actually had voted for a 50 basis point cut rather than 25 basis points. So interesting to see that the tendency was for a larger cut than a smaller one. But on the back of that, they also talked about inflation, which the Bank of England is now seeing as persisting at a higher level than they'd previously expected and for longer. And at the same time, they've halved their expectation for 2025 growth in GDP terms from 1.5% to 0.75%. Now, one thing I would say is that I'm grateful that the Bank of England's taking such a long-term view of, in particular, inflation, because they're now expecting that inflation will come down to their target rate of 2% by the end of 2027. So it's a very long-term timeframe to be looking at. That's allowing them to say that because they're comfortable it will get there eventually, they're comfortable to bring rates down now, which is exactly what the economy needs. And it feels like the right thing to be doing, despite the fact that inflation is persisting higher for longer. So Alice, interested to hear your take both, I guess, on the interest rate cut and what that means for the building construction sector, and then obviously any other news which has been going on in the space, because the building construction space is always something going on. It'd be great to hear what's been happening in the last few weeks.
Thank you, Gareth. Well, the house builders shares are off to the races today following the rates decision, not so much as a result of the 25 basis point cut, but much more importantly, as you indicated, two of the MPC members voted for a 50 basis point cut. That's debatable whether there'll be such a big cut going forward. But what it signaled was more cuts quicker, which is a complete turnaround to only a few months ago. For the house builders, it's obviously good because the cost of borrowing, but not just so much the cost of borrowing becomes cheaper for would-be house buyers, but the availability of that credit. It's an easier hurdle rate for lenders to actually put new products on the market. But for the more build-to-rent type developers, and I include among that Watkin Jones, one of our clients, there's a positive double whammy effect. Not only does the economy improve as a result of rate cuts, but their institutional forward funders' cost of debt goes down as well. And that's what's been holding back new investment in the sector. But stepping back a few weeks to the start of the year, most of the industry started the year relatively upbeat despite the economic gloom. And I think one of the specific issues that made them feel more positive was planning had become much more streamlined. Angela Rayner in particular had been systematically overturning projects that had been turned down by the previous administration. And it basically sent out a big signal to the entire planning system that she's not going to take kindly to any rejections.
Right. There was barely a week was going by when they weren't announcing some removal of regulation or reduction of barriers to house building. So, yeah.
Absolutely. And to quote Barclay Group's chief executive, Rob Perrins, the default answer had previously been no, and now the default answer is yes. And that's trickling down the entire system. So they started the year quite well, but then gilt yields went up and up and ironically ended up higher briefly than during the infamous Liz Truss mini budget.
Indeed. Yes.
They've now been coming down, and actually just ahead of today's announcement, the latest average mortgage rates had tweaked down ever so slightly. I'm sure they're going to go down further. So that's always a good backdrop for the house building sector. There's possibly further good news for the house builders and their supply chains in the next few months. For 5 quarters, house builders have been completing more homes than they were starting. So they were effectively destocking. And it looks like they may well be running perilously close on the number of finished units they sell to the public. So I think there's going to be quite a marked increase in new sites being started, new homes being started. And that's good for the very early stage of the supply chain, which is civil engineering, which is Nexus Infrastructure Group, one of our new clients. And slightly further down the line, the actual foundations themselves, which are represented by Van El, a foundations company. And the next thing to appear on site is bricks and blocks, and that's Forterra, the second biggest brick manufacturer, again, one of our clients. And the brick industry has been destocking. They had a stock overhang for quite some time. So the supply and demand are much more in balance just now. So they've had a pretty tough time for the last 2 or 3 years, but I think it's worth looking at Forterra.
So, yeah, there's a real sort of, as you say, cascading through of the sector of the destocking effect as builders have been basically selling houses more rapidly than they've been starting them. And that obviously can't go on forever. And if we're now working that through, then you're absolutely right. You'd think that the early phase builders and contractors will start to see activity picking up. So, yeah, could be good for any or all of those three. So, yeah, interesting. Anything else going on in the sector?
Yeah, it's something I've just been picking up on. It's only for buildings above 18 meters or 7 stories. It's called the Building Safety Act, but every new residential tower has to have two sign-offs. The first one is before anything gets built, and then there's a sign-off before anybody can occupy it.
Is this a post-Grenfell thing?
Yes, totally.
Okay.
It's all post-Grenfell.
Okay.
But the real problem, which was highlighted in the recent results meeting by Van Eyl, was that it's taking longer and longer to get these. Basically, there's a lack of resource out there in the building safety regulator to sign these off. And there's a bit of a bun fight to get qualified staff. And there's talk about doubling salaries just to keep even the experts in the companies themselves to sign off in the regulator. And this is quite an issue going forward. There's a whole load of finished buildings all ready to be occupied, and they're sitting waiting for weeks and weeks and weeks before you get sign off on that. So that's something to watch out for the near future. And there's almost been a sort of conspiracy of silence out there because the developers don't want to kick up too much of a fuss and complain about it because we're at the anniversary of Grenfell. But there's a tricky balancing act here, in terms of people need houses as well.
They absolutely do. And yeah, I obviously understand why those checks need to be undertaken, all the obvious reasons, but it feels like there's a potential logjam there in terms of the sign-off process. So hopefully they can get that cleared. But good to be aware that although lots of positive signs for the sector, there are always a few things on the horizon.
But still, today, again, there was a slightly gloomy survey on PMI data from S&P Global, as they're now called. It showed sentiment turning negative for the first time in about 11 months. And that's a bit of a delayed reaction to the national insurance increases.
Yeah.
But I think the renewed focus on growth and cutting interest rates may mean that bounces back. But there's still quite a lot of more recent negative data out there.
Yeah. Okay. Well, thank you for that. That's a fascinating run through of the sector. Lots of positives and a few negatives. And as always, there's lots to talk about in building and construction. So yeah, fantastic to get that. And it will be interesting to see how the sector reacts to the interest rate changes of today and as we move into the rest of the year, how it works through all the planning issues, the sign-off issues and the demand issues. So yeah, thanks for that.
Yeah.
More broadly, in terms of the UK market, we've had news from a couple of other progressive clients across the week. TinyBuild, the game software developer, gave us an update on their FY24 outcome. Actually, it was quite a reassuring and in-line update. This is the market for relatively low-budget games has been very, very tough over recent quarters or recent years, but it was quite a nice, reassuring update from TinyBuild. And then STV Group, they announced a pretty major partnership with a group called Premier Sports. Effectively, they'll be bundling STV Player Plus, which is the non-advert version of STV Player. They're going to be bundling that for free with Premier Sports packages, which are sold to customers for, I think, about between £10 and £15 a month. So it's quite a good deal for customers. It's also a good deal for STV because it will be propelling them quite dramatically in the direction of a younger and more male audience, which are two areas that they're keen to expand and grow the audience segment. So it seems like a win-win deal for STV and Premier Sports. And then looking forward to next week, on the macro side, we've got US inflation on Wednesday, an expectation for a report of 2.9%, which will be flat year on year. And then later on Wednesday, we've got testimony details from Jay Powell, the Federal Reserve Chairman. So again, interesting to understand his thinking or the way that he's been looking at the rate outlook for the US economy. And Thursday, we have UK GDP, which is expected flat at 1.1%. And then Friday, we've got EU GDP, also expected flat at 0.9%. Interestingly, both of those numbers are now ahead of the Bank of England's expectation for 2025 growth of the UK economy as a whole, so that the Bank of England is actually expecting the UK economy to slow down as we go across the rest of this calendar year, which is a slightly depressing way to end, but that's where we are. And as we've said, I'm sure they don't really know for sure. So let's leave it at that. Thanks again for your time, Alastair. Good to have you on the show, and we'll catch up soon.
Yeah.
And everybody else, we'll talk to you this time next week. Talk to you then.
Brought to you by Progressive Equity.